Hello, this is Jim Riggio. Today is April 10th, and this is Capital Discussions Monday Market Muse. Before we get started, a quick disclaimer. Capital Discussions is not a broker-dealer investment advisor. This is presentations for educational purposes only. We have no way of knowing what level of risk is appropriate for you. We're not making any trade recommendations. The risk of trading options is substantial. Please be aware of all trades prior to placing any trades. Hypothetical computer simulated trades believed to be accurate. However, profit will vary due to such factors as liquidity, slippage, and commissions. Okay, I had an interesting week this past week. I was actually quite concerned as we went into the close on Friday about how we would end up opening. What I'm going to do today is I'm going to go over technical analysis. I'm going to go over the part of technical analysis that I believe to be most important and I rely on the most. And that is the fact that the technical analysis du jour, okay, that's happening to work for that day, works absolutely great until somebody finds something better. They abandon it. The high frequency guys end up finding out that too many people are using it, and then they do a crack and snap, as I call them. They'll bait you. They'll end up having you end up getting either long or short, and then they'll rip the market in the other direction, okay, forcing people out. And so I really believe that, trying to find out, the right number of days to end up using in a MACD or finding something like, which CCI should I be using, any of the oscillators, none of them, okay, I believe you can truly rely on for, a number of successful trades in a row. I do think the moving averages are somewhat important because enough people end up looking at them. Also, the high frequency guys end up finding them all the time because they know so many people use them. So they will end up having just a series of pushing them through and then letting them go back. And so they can't be used for trade triggers, but they can be used for a longer term direction. So what can we use? There's a reason why I always start with this current chart, okay? And the chart that I always end up starting with is the chart that ends up showing where are the trend lines. And yes, a lot of times they're broken and then they end up coming back, or price levels will be broken and then they end up coming back. But I always end up starting with this because what this ends up showing is that if anything changes, if they go to a different oscillator, they move from fast stochastics to slow stochastics or full stochastics. If they end up moving from there to other, let's say, bands like Bollinger Bands or anything else that will end up having a variable that you can end up putting in. Use the 20, 50-day crossover. Most people end up looking at something like that, but all of a sudden they say, oh, you know what, let's do this. Let's use an 1848-day crossover because the thing is, this way we get the signal just a little bit sooner than everybody else. There is no magic. When I end up talking about technical indicators, a lot of times you'll end up hearing me talk about a confluence of indicators, right? Are all of the indicators, okay, on the oscillators all kind of turning? Which ones turn faster? Which ones turn slower? I don't put credence in any one of them. And even as a group, I think that they become less important than finding a good support line, a good resistance line, or most importantly, a channel, because many times you'll see things trade within a channel. So here's the way I normally end up starting, right? Long term, for those of you who haven't seen this, I'll go back to the monthly so you can see how everything, these longer indicators had started from particular highs, particular lows down here at the very bottom after the financial crisis, highs that we ended up having that ended up looking like real resistance at one point, and then other lines that I've been taking from extremes, like here. This is the extreme lows that we ended up hitting from February of last year. And you can see that this was a particularly good one because this particular support line, I could end up drawing all the way back to here. And even if you wanted to, you could end up saying on a monthly basis, Jim, you really didn't break it until November of 2013. And so when you end up have particularly strong lines, they become important. Let me go back to the daily. Okay, so it's the same chart now. I'm just going to end up moving it to the daily. Um, Having said that, let me just highlight the last 2 years plus. Most gaps, nearly all gaps in the SPX fill. The one exception, and oh, by the way, there's probably about 8 exceptions in the last 20 years. So, 8 times in 20 years is not a lot. Every single one of them is some type of breakaway gap up, okay, that we've had here. And you can end up seeing that normally the two gaps that we've had over the last 2.5 years happened from the February 2016, okay, breakaway from the bottom. And then also as we broke away from the gap, and this gap was caused by Brexit. And so when I take a look at these are weaker gaps because they were such breakaway gaps. But when gaps normally happen when there aren't such extreme, intense events, those are the ones that nearly always get filled. So you can end up seeing that the way I end up drawing a lot of my lines is that some people say, "Oh, do you draw your lines from the very tops, okay, the spikes, or do you end up using the bodies?" The answer is, well, it kind of depends. It could be either. Okay, what you end up doing is that you draw one, you stick with it. If one ends up looking a little bit better, you can keep both of them on there for a while, and then you can even delete the ones that don't end up appearing to end up being as influential in the price of trading. Um, Please ask me questions here as I go through on technique. If you do anything different, I'm very interested. I don't think this is the be all end all. Okay, what I'm sharing is what I end up doing. Okay, in a hope that it helps a lot of you guys. But if there are thoughts, okay, that you have that you may do something different, or if you have questions, please type them into the chat as we move along. Okay, if I take a look at some of these gaps that we ended up having, they definitely filled. I'm going to get to another more recent gap in a minute, but since it's filled, I'm going to have to end by showing you some snapshots that I've taken. So let's take a look at a couple of the lines and why I've drawn them. Okay, from over here, here is the low that we hit from the elections. Now, if I ended up actually showing the futures, okay, we had a much larger gap down, so it would look very, very different. But once we ended up moving sideways, I had drawn a couple of lines when we first got to this point, when we first got to this point and this point, and then as we got to the lows here, I drew them, and one of them usually ends up sticking. It's usually not the first line. You have to keep them going, but I'm looking at this pink or maroon colored line, and you can see the lows that happened here. And after I drew the first one, it actually touched 3 times. It touched over here, which was kind of interesting, that it ended up being the support when it looked like we could have sold off harder. It touched here again, and then when we broke it, look at what happened here on March 21st. When it broke it big time. Okay. And so that's why I leave these on here sometimes for, you can see, from the financial crisis, some of these blue lines, like this blue line on here, it's been here for nearly a decade. So you don't want to end up just discarding them until they're really out of the way. What I end up discarding are lines that are shooting up way too high, that we cannot end up seeming ever to catch them again, or I don't discard lines that are moving up when they're below us, but like, for example, these downward lines. If we end up moving up, and I assume that at some point in the future we will end up getting above these lines, that's why you don't see any longer term downward lines. If we were in a multi-year bear market, yes, there would be a lot of red lines moving down. Okay, so the way, and you should have a color code for yourself. What I end up doing is that the long-term uptrend lines are blue. The shorter term, by shorter term I mean like 2.5 years, 3 years or less, are this pinkish color. My price support levels, where I think that we definitely have some real support more resistance, one turns into the other once you pass it. I draw those in yellow. Like for example, let's take a look at this 2277. And this is what I meant where lines aren't perfect. They get fractured, okay, many times, only to end up retreating back onto the other side. So if you take a look, this line got fractured here, okay, here, here. And when we finally broke through it here on the next day, we gapped above it. When we came back down, we did break through it 4 days in a row, but ultimately it held. Okay, that's why you can't end up using a line in its absolute terms. Why? I'm not the only guy in the world who saw this line, right? Every high frequency trading algo trader in the world ended up seeing this. And so they're going to try to end up scaring people out of this. And they very well may. Okay. We won't know, like, for example, when we were trading down here during the middle of the day and we hit our lows, this line looked like it was fractured and it was never going to be touched again. Well, it was. Okay. So it's not it's not always perfect, right? And if you're going to end up getting close to a line, many, many times you will get all the way to it and touch it at least. Many times go through it. And so when you're basing your trades on something like that, you really need to end up making your decision what you're going to end up doing. And now once you end up making your decision and you do this, okay, you do this a number of times. Now here's the really hard part for people. You can go back and you can try to back test this and look at your 15-minute intervals. And if it gets here, I'm not going to do this. If it gets here, I'm not going to do this. If it gets here, I'm not going to do this. But when you're in back test mode, hitting enter, okay, and moving 15 minutes every time you hit enter, okay, or hit page forward or arrow forward, it has little to nothing to do with the way you'll feel and the way you'll actually trade this when it's your hard-earned money on the line and you're losing money as you start to end up going to a particular line. You have to end up having whatever works for you to end up pulling the trigger, meaning stopping out, getting into a trade, whatever it is, okay, that you're going to end up doing, or the patience to end up seeing it through. Now, you can only have patience to see something through if you have a longer-term plan. Right? If you have a longer-term plan and your risk-reward ratios are proper. If I'm touching this line over here, okay, this downtrend line that had been formed, and I'm touching the line over here, if I have a short-term plan or if we go down, and this is the way I always view it, what happens if we go down another 10 points or rebound another 10 points? If I don't have the risk-reward ratios working on my side, I will not take the trade no matter how strong I think it is. So, for example, during this day right here, if I'm going to end up losing, let's say, $1,000, okay, if it goes down another 10 points, but I'm only going to make 500 if it bounces 10 points, that's a horrible ratio. Okay, so even if I feel really strong that this trend line's been holding, it's going to end up working, I'm not going to end up, okay, taking that bet nearly as much as what happens if we end up losing that same $1,000 if it goes down 10 points, but we make 3,000 if it bounces back off of it. Oh, now I feel really, really good about taking this bet because, number one, I believe in the indicator. Okay, in this case, trend lines, not indicators such as a MACD or stochastics, a CCI, a William percent R, or anything else, okay, that I might end up looking at. But are there real trend lines? Because when I see trend lines or support levels, that's the culmination of the entire market's opinion. That's really, really important. You see this 2277 line up here? Okay, that wasn't me drawing this. This was the aggregation of every institution, hedge fund manager, high frequency trader, algo, retail trader. It was the culmination of everybody's influence, and it was the collective market's opinion. Okay, the collective market. Sometimes you'll hear people refer to it as Mr. Market. Okay, the collective opinion of the market is always right, right? Whichever way it's going to go, it's going to end up going. And you can end up drawing any lines you want, but the market's still going to sometimes break them and keep moving, through them, and you'll be dead wrong. Other times they'll end up acting as resistance or support. They'll bounce off of them, they'll come back into your range. Which one? Don't know. Okay, I do know that the stronger, okay, the more times we've tested. A particular line, and the more times we bounce off of it, usually the stronger it will end up getting. So the 2277 is a great example where we kept touching it, touching it, touching it. Then when we broke it, we really broke it, and then when we came back, we touched it and passed it a few times, but then we came off of it and ultimately acted as support. One of the things that ends up happening is after the 2277, that when we ended up running up to 2300 over these 3 days. Okay, by the way, you see we had a gap here that filled, we had a gap here that filled. Can you guys see that? Just say yes if you can. I want to make sure you guys are following this so that we end up seeing the difference between the day on January 24th and then on 25th. You can end up seeing, and here, let me highlight this so it makes it a little bit easier too. Okay, you can see here that the high of this day is well below the low of this day, right? You can also see that the low of the 27th is higher than the low of the 30th, but both of those gaps ended up filling. Okay, and so that was what I meant when I end up saying that most gaps fill. Okay, so we end up having these lines, and this is another great example. We talked about here on the 21st. We ended up coming down. Now, this line here, and there's no magic in the number, right? I drew it at a particular level. This line could have been drawn a little bit lower. If you drew this line anywhere between 2252 and let's say 2248, I would be fine with that. And you could end up seeing that if realizing it's not an exact science, okay, that it is going to be more of a buffer zone, you can see that this 2250 has really ended up holding. Okay, when we've come back down. Now, this right here, that we've broke it, we've come back through, and once we've gone through it, it's held. That 2250 area is really, really important. Okay, because of the way it has supported. So what I wanted to end up doing is I wanted to end up taking you back to, I guess it was last Wednesday. It was the 5th, right? April 5th. I wanted to take you back on this day. Let me bring a couple of pictures up because the thing is that I needed to end up making an adjustment on this day. Okay, so here was just a screenshot that I ended up taking, and what I ended up drawing is that I drew, the highest high that we had at the closing, and then I drew a series of lower lows. Now, originally I had a higher high here. I used the peaks. I came to this one. We obviously had broken that, and so this was one where I had actually two lines drawn using the peaks, okay, which I discarded, and then using the closing prices as my highs. And so what you can end up seeing here, this is a picture midday on the 5th where we had three different indicators that are pretty strong at this point, okay? Those three different indicators are, number one, we have a gap, okay, from one day to the next. You can see that. Number two, the 20-day, which is this green line, has really been acting as support or resistance. So we didn't even have a battle at the 20-day. We just gapped the 20-day. So to me, that made that gap even more likely that we would at least come back to the 20-day and test it again while it was in the gap. We ended up having the direction of the 20-day go from pointing from upper left to lower right to at least flat, maybe even up a drop. And so now we have a change in direction, okay, on a gap, and there was never even a battle. It was like a bloodless battle. There were no bulls, no bears fighting. We just gapped straight through it. They're normally going to bring that battle back. This wasn't a breakaway gap from a bottom after we had this horrible sell-off. So I felt, rather confident that this would end up filling. Now, how long? I have no clue. Many times it takes, sometimes gaps fill within the day. Sometimes they fill in 1 or 2 days. Sometimes it could take weeks or even months. Okay, but they tend to end up always to fill. And second, we have this long-term channel that has now been going a year and 4 months. Okay, in this channel that I had drawn. Okay, in the blue, the upper channel, not just a trend line, but a channel. And I'll show you my channels in a second. But I see the channel moving up, and you can see that once we broke above the channel and we had this breakaway top, some of you may have remembered I ended up quoting some Ned Davis research that talked about, I forgot what the exact number was. It's about 20 breakaway gaps since 1900. Okay, so in more than a century, we had about 20 breakaway gaps, and a breakaway gaps they had defined, upward moving market where we had this blow off top, not breakaway. They used a blow off top, I think was their words, and this was definitely, having this huge gap here. Once we already got above a trend line, that those normally don't hold, right? You normally get some type of sell off on this. Okay, and that's what ended up happening. So it was, a lot of people will end up using the term that the market makers are going stop hunting. Of course, they're going stop hunting. They're trying to take out all of the stops that people might end up having. Now, in this case, you say, well, Jim, how do you end up using a stop when the market's going up? Anybody who's short. Right? If you own long puts, if you own put spreads, if you end up are just a naked short, when you end up having anything run up, they've been taken out. Also, you may have a bunch of hidden limit orders, okay, that will end up being let's take the money once we end up getting here. So they take these guys out. That means the next time they come up here, they've softened up the defenses, okay, of the bulls or the people who want to sell in this area because it's reached it and they've sold. Okay, so they now end up reaching their high, and they start to end up pulling back. And there's this long-term trend line that we touched, and then there's also, which was the blue line that goes from lower left to upper right. And then we were also approaching here the shorter-term trend line from upper left to lower right. So we now have three indications, okay, that this area right in here, okay, and whatever it might end up being, okay, that 2375-ish area, that should be a battleground. Now, here's one of the things that ends up happening, and really think like a military war strategist here. The bears decided not to defend this area. They retreated. So they retreated, and they were going to end up picking another area to defend, another area that they thought where they had much better coverage, okay, and could mount a much better defense. So they let this go completely during the day. We ran up, we opened up higher, we gapped higher, and we're just marching higher and higher and higher. Okay, we hit our high just about 2 o'clock. And what I ended up sending out to all my Kevlar subscribers at this point at 2 o'clock, I said, because I had a trade on where I thought that we were going to come back down. We were negative delta, but I didn't have a lot of risk, okay, to the upside versus the downside. I did have probably a 2-to-1 ratio type of thing where I would have lost another, let's say, $1,000 if we went up, but we would have swung in our favor by $2,000 if we went down. And we end up having these scenarios with these three factors. This is a risk to end up taking, in my opinion, because of the way the market ended up playing out in the long term. Now, there is a confirmation that I always look for, okay? And that is I take a look at the 1-minute chart, and I take a look at the volume, right? The volume that has been pushed on the way up versus the volume that has been executed on the way down. And what I was seeing on the 1-minute charts is that we would end up moving up slowly on lower volume, and then all of a sudden the volume would come and we'd have a quick few down bars, maybe draft down for 5-10 minutes, and volume would ease up, and then we'd end up going back up again. Okay, that was really important. So when I ended up seeing that, I ended up saying, okay, doesn't make sense to me. Okay, that the Bulls can now miraculously end up having another battle and win this and gap up again. So therefore, I held a trade. Um, a lot of people got very nervous. Okay, I mean this isn't something that it comes natural to you. Okay, this is a skill that you learn over multiple years. You watch it. You have a lot of battle scars because you were wrong. Okay, as many times as you were right. The losses always seem more painful than the gains until you start to take a look at the balance of your account over time and saying, wow, it keeps going up. And so that becomes a really important point. So what ended up happening later that day? This. Okay, we 2 o'clock. We hit our top, and we just kept selling off and selling off and selling off. We filled the entire gap that day, and we closed below it. Um, what I ended up doing, and this is something that most people would have once you came down here, I think, end up trading when you have such a reversal in a day. Okay, it's been my experience that probably two-thirds of the time you get some continuating or a continuation of the recent trend, and you tend to end up getting a gap. The fact that we had this 50-day moving average that also kind of ended up being a point where we bounced off of last time, I thought that the following day we would end up moving down a little bit more and bouncing up. This following day, I was wrong. Okay, let's go and take a look at that chart, and I end up keeping this over here. Okay. Okay. So what ended up happening is the next day, we got a little bit lower than the low, but not close enough to it, and then we bounced back up. And at one point, I was like, okay, you know what? I'm done. I've made my call. We bounced off of it. Time to end up taking our winnings from that battle. Okay, and we started to bounce back above it. Now the 20-day, okay, and you can see over here, right, the simple 20-day moving average. You can also see that the orange is the simple 50-day, and then I have the 200-day. The 20-day, we've been bouncing on both sides of this. Today we're obviously up. The futures are up about 8.5 points. But I have other concerns about today. Okay, and I'll end up going. Yeah, somebody did end up putting up about the crossing of the futures, and I'll end up getting there in a minute. That was the second thing I wanted to be able to end up showing. So from here, what I end up seeing is that we definitely have the resistance below this channel. By the way, this channel still is well defined. Okay, we have this sloping down channel. So since it's proven a few times, wherever this upper channel will end up being, if we continue to end up moving up, I think will end up being a real resistance. And even if we get through the upper channel, then we have the long-term channel to end up contending with. So I think that we have a fair bit of overhead resistance that we're going to end up facing. We did get above the 20-day today. That was a huge thing that we've moved above the 20-day because that's been the battleground. And obviously you can't move up unless you're on the upper side of the 20-day. The 50-day did come in here. It is acting a little bit like support. So now we kind of have this pendant or triangle where our resistance levels are coming down, right? They are getting closer and closer to where the money is. And we have some support levels, not as strong, okay, that are also moving up, meaning the 50-day. And we can go through oscillators and other things, but these are the strong ones. If we do end up pulling back, you can see what's happening, that if we pull back, this trend line, the short-term trend line that's in red, that our support line gets lower every day until this channel is broken. Okay, until this channel is broken, I will end up using it. There's an old expression, the trend is your friend until it ends. Right now, the trend, okay, is mostly down, okay, in the short term, but we do have some factors like the 20-day that's acting as support right now and the longer-term trend that are moving up. And so as these things converge and get closer, when we break out of them, okay, we'll end up breaking out of them, I think, in a pretty significant way. Okay. Obviously, we're up 10 points at this point today, so it's the Bulls who are definitely winning today. Any questions about gaps, trend lines, why I think oscillators, okay, or momentum factors are important, but not nearly as important as listening to what the overall market is telling you? Because next thing I'm going to go over is I'm going to switch over to VIX futures. Do I look at each volume bar? Yeah. Okay. So let's take a look at what I end up doing on a daily basis. Let me come over to here, and I'll show you my trade window. Other questions? Let me see before I end up jumping over. Textbook ABC correction from the latest high. Yep, without question. Okay, that it is. You see the triangle in the SPX pattern. Okay, I can end up drawing, and let's just draw the lower channel right now, just so that you can end up seeing this one. I won't draw it as a channel. I'm going to draw it as a trend line, but I can end up either using the lows of the day or the opening, the candles. So if I do something like this, okay, you can end up seeing, and let's change that color. Right. Let's make the upward stuff be short term be green. Let's make it a little bit wider. Okay, so you can see this upward trending line here, and here's the flag pattern that I was just kind of talking about, how, the bottom support lines, including the 50-day, are moving upward, and the trend lines, when you have this flag pattern, what happens, it's kind of like compressing a spring, right? There's these forces from the bottom that are making it go up. There are these forces from the top that are making it go down, and it's getting tighter and tighter and tighter. And when it releases, boing, it usually really moves and moves very, very quickly. Okay, so thank you. I hadn't done this. Oh, by the way, what I'll do is that I'm going to end up keeping that trend line, and all I'm going to do is I'm going to come over to here, and I'm going to end up saving my grid. And this is my basic too, right? Basic is just the name that I'll keep for the SPX. Okay. I also have my drawings. Okay. So what I'll do is that I'll come over here. I'll end up saving my drawings, and this is I end up keeping two sets of drawings: the long-term drawings and then my channels. I really haven't deleted anything. I change my number of my channels a lot of times when I delete a bunch of stuff. Okay, and you can see that. So I've saved these things. So next time I come up here, I haven't taken out that gap. I'll do that next time. Okay. Um, let's see. The green line from the previous state is cruising on the lower lows. Exactly, exactly. That's what it does. What you're looking at is the reason why I ended up choosing. But by the way, I could have chosen the low, and a lot of times I'll draw both of them. The reason why I drew this one for at least right now is one. I was going to end up going to the opening from today. I was also going to end up thinking that since we found the trend lines, okay, here, and I was using the bodies on the top, I'd use the bodies on the bottom. It's not perfect. We can end up going back to previous days. Somebody ended up saying that I could even go back to December 30th. Okay, and that would actually work. And so if I come back to drawings, if I take a look at, let me use the bottom here. All right, if I take a look at this bottom, that didn't work. No. That's why you save your patterns. The easiest thing sometimes, if you mess up stuff, all you end up doing is coming back, and you can just bring your drawings back, right? Load channel 2, because I just saved it, and I can come from here. Oh, you know what? I have on a vertical. That's my problem. My drawing is wrong. From there. Right. I could draw the bottoms, okay, from it, or I can also draw the bodies. Okay, so you'll see both of those. Let me come over to drawings, point. Okay, we'll make both of these green. And I'll leave them on here for a little while, and we'll see. Okay, and let me just do the same thing. I'll save my drawing set, and I'll also save my basic 2. Okay. And now, from a longer term perspective, I can see some of these things that have really ended up holding. So it's interesting that it's also the steepness of the lines that they've broken. Obviously, the lower line ended up seeming to be much better in terms of its support line. And so again, it's even a longer term pennant. This is something that's really important, by the way. And thank you for pointing out, Pedro, that the more a trend line, okay, gets to be reused, or trend lines are similar, the stronger they end up getting to be. Okay, let me take a look at some of the shorter term stuff that I've done. Here is what I keep in my trade active trader tab. Let me bring it over. I'm going to detach it. Okay, and we'll bring that to here. Okay, what I tend to end up looking at, okay, in the 1 minute bars, and it's not perfect. And if you haven't seen the 1 minute reading the tape that I had done with Paul Demers, I strongly suggest you do, because I can only look at this on Thinkorswim in 1 minute intervals. Paul actually has actual trades, so he can actually see where the volume of each trades are. So let me go through a couple of things. I look at 2 things, right? I'm looking at the bars on the up or down. I'm also looking at amounts of volume that's traded today. Okay. By the way, when I say today, I mean from the time you've opened your window. So I opened up my window today. I don't know what time it was, maybe 8 o'clock. And so once I open up, your system will keep, not Thinkorswim's servers, but your desktop will keep the volume here. And you'll see the volume, and that's what I really care most about, is where is all of the volume really happening. That becomes something that's very, very important. And many times what you'll see is that if we end up forming a big hump like this, and let's say we sell off really hard during the next few hours, and then we're bouncing back up, many times when the bounce up, it'll end up getting back to this larger volume amount. What I'm looking for is when we start to end up moving, okay, what's going on with the bulls and the bears. And so let's take a look at this hour here. So what ended up happening is that obviously a lot of purchases, a lot of buys came in because the volume came up and it drove us up. Now, it seemed that when the buy orders were done, okay, that we moved sideways. So this doesn't really tell me a lot. Now, volume ends up sinking, so we're moving sideways. When we start to end up moving up again, it seems that as buy orders come in, we move up again. As buy orders come in, you can see that there were a lot of things that drove us up, but we probably, with all of these buys, we went all the way up, we came back down, and then when volume's up, we still keep going there. Now, this sell means absolutely nothing. A lot of people will say, oh my God, look at this big sell bar. We're going. No, look what happened. It was on no volume. Okay, it wasn't on higher volume, so it really doesn't count. So I don't consider this to be a negative, not nearly as much as I consider, say, these 2 bars to be, because these were on bigger volume, not as big as we had over here, but they were on bigger volume. And when the volume led up, you can see that the selling stopped. So it's telling me that, yeah, there are some bulls, but maybe these bulls were just the guys who ended up buying over here. So there's some bears, okay, who are selling, but few, versus the bulls over here. When you take a look at this, where they drove up, and then when they stopped their buying, all we did was move sideways. Then they bought again, and they moved up again. And so, have the bulls ended up finishing at this point They could be because in the last 6 7 minutes, okay, the bears have been the ones who have been doing more of the selling, but it doesn't mean anything. So that's the way I look at volume bars. When you look at them, okay, day in and day out, and then see what's going to go on, and then see what actually ends up happening. That is something that's really, really important. Okay. The other thing that I look at, and hang on because this thing has to be changed, is the following. I look at the VIX futures, and the VIX futures are in the bar. Oh, okay, over here. What I also tend to end up keeping on this is the second month. So if you take a look at here in pink, you see the VXK. The VX futures that I'm looking at right over here, this is the current month, right? So the current month is April. The current month is VXJ7 is the symbol in Thinkorswim. So I look at the second month to see if how far of a distance there are between the two. Okay, this is not enough to end up having any type of a real analysis other than the short term, and that's all this is. It's a short term that I'm looking at this. You can also end up seeing here on the volume, okay, not the greatest, and we've had the same thing here. You can see that when the VIX got pushed down, it got pushed down on bigger volume. We were real fat. The volume started to pick up a little bit. That got us above this resistance line of 14 spot 15. And you can end up seeing it push us in, and now we're in this 14.15 to 14.20 range. The longer term stuff isn't moving. Let's take a look at some of the longer stuff. Okay, and what I tend to look at is the term structure. Okay, so what I'm looking at is twofold. I have in here the VIX, right? These bars are the VIX. Then each one of these lines going up represents the futures. Now, what I tried to do is I tried to make, kind of like the colors of the prism starting and I know I don't have all seven. It was too difficult to choose them, but I was relatively close. Other people say, oh no, they're closer to remember the five colors that Homeland Security used to have. So I basically started bright blue, and then this paler blue, aqua color, green, yellow, orange, red. Okay, and those are the 1, 2, 3, 4, 5, 6 colors for the first 6 months. So what I look at, okay, here in this blue, and you can see the J. Okay, the J. Okay, right there. Do you see that VXJ? Okay, that's April. Okay, that's April. And so the next color, aqua, is K, right? K is May. Now, normally when the markets start to get scared, okay, what most people, when you hear traders talk about contango or backwardation, the only thing they're looking at is the crossover of these two lines. Okay, this is important, okay, because usually you will not see a market sell off hard, okay, without the front month VIX futures being higher than the second month VIX futures. Okay, is it always true? No, nothing's always true, okay, when you take a look at this stuff, but it does happen more often than not. Now, the problem is that people treat this as a binary event. Oh, we're in contango. Oh, we're in backwardation. And it's true. It is a binary event, right? Either the front month's above the second month or it's below it. But that's not always the case. Usually what ends up happening is that if the market's going to end up turning, you'll see the front 2 months maybe even get higher than the third month, okay? And you'll see the way this gets wrapped. Now, I like to see the noise. I want to go back, okay, 20 days and see exactly what had happened. Now, by the way, This red dotted line, as a lot of you guys know, this dotted line here is for it's for the expiration of the equities. So this was our normal third Friday of the month. VIX futures don't expire on the third Friday of the month. They expire on the opening print on a Wednesday. The first 2 months out of the quarter, they expire on the Wednesday before expiration, meaning expiration of equities, third Friday of the month. So they end up going on the Wednesday before the third Friday. On the last month of the quarter, they expire on the Wednesday after expiration, which meant that expiration in March, right, third month of the quarter, was on the Wednesday after expiration. So here's expiration day. So it went 1, 2, and so on this Wednesday morning is where the futures expired. Okay, that's a really important thing. By the way, you can see that. It's not like Thinkorswim is hiding it from you. If I actually end up coming in here and putting VX, okay, now I get all of this noise because I'm looking, and yeah, I can end up coming over here and I can show extended futures. Take out extended hours trading, so there's not as much noise in here. So here, I want you to see this green line right here. If I hold my cursor up, and you can see over here, and I know it's a little bit faint, but that says VX J7 means, and it's on the right side. This is when the J became the active contract. So the bar chart here, the VX. This was the March. So this was actually the March futures. And the active contract went from March on the left side of the green line to the April on the right side of the green line. That's why this blue line, which clearly states just J, is the April going straight through. So when you're looking and you go and take a look at the history of the VX futures, you have to realize every single expiration, which is every single month, you're going to have a jump. Okay, or a gap in it. And it's not that, oh, look at how the VIX contract went up. No, it didn't move at all. I mean, practically. Look, day after day. And so that becomes something that's a little bit, you need to be very cognizant of that. What I want to show you something is a market that looks very normal to a market that doesn't look normal. I want you to take a look as we're going into expiration, and we don't have a lot of days here. There's only 5, but this is pretty typical, where you see the lines, each of the VX futures, lose value over time. They do, okay, because time, okay, and this is something that a lot of people don't end up realizing. This really helped me, okay? Time is basically, the value is built into the futures. Time on an equity is built into the options. That is critical. So what ends up happening is that because time, okay, let's say with the, you ever notice the difference between the ES minis and the SPX? Okay, right now there's about a 3-point difference, 2.75 point difference. Basically, that time, the only time in there is the difference on interest rates and dividends, and they subtract one another. And the SPX is higher than the futures. When the SPX is higher than the futures, that means that the dividend rate, okay, is higher than the risk-free rate. And I won't get into all of that, but what I will end up telling you here is that the VIX futures, because there is no way to arb them, right? We've gone over this a bunch of times. It's the only future where it's not, that you can't arb it, right? You can't end up selling the future and buying the underlying. You can't sell the future and buy the individual stocks that make up the underlying, like in the E-minis. You could sell the E-minis and buy the SPX. You could sell the E-minis and buy the SPY or a ton of other ETFs that mimic the S&P 500. You could end up selling the minis and buying all 500 underlying stocks, right? There are a number of ways to end up, arbing a future when the underlying is traded. The VIX is not traded. It's calculated off of a number, a large number of SPX options contracts. If you go and try to end up buying the options contracts in the exact formula that make up the VIX, it will end up moving it so dramatically that it's you can't trade it. I don't care who you are. Now, a lot of people think that this is, oh, it's too complex, it makes it too hard. No, this is a huge advantage to us. Why? Because the high frequency and the algo guys have to show their hand using VIX
Incoming
futures.
chat.
Now you say, but Jim, they'd never show their hand. Why would they end up doing that? That doesn't make any sense. The reason why they use VIX futures and options on VIX more so than anything else, and oh, by the way, I've done some consulting work for high frequency trading firms. I know that usually, their largest single commissions bill will be on VIX based products, right? VIX futures, VIX options. Okay, by far. The reason is that the price is so low, and as a percentage, it moves so quickly that they can make the most amount of money on it, right? They're looking about leveraging their money as much as possible to make as much as they possibly can. So they're going to end up trading and trying to end up arbing the futures, but there's no way really to end up arbing it. So what are they doing it? They're using it for direction. They're using it for direction. So usually what will end up happening is that the high-frequency guys will show their hand in the VIX futures faster than anything else. I can tell you for the Kevlar subscribers, who are watching, right now, they're probably wondering, right? You guys are probably wondering. What I ended up doing was that I bought a small put spread. I basically rolled one of my puts higher. Okay, and I did that because I was concerned that the selling pressure ended up not looking very good, meaning that I was fearful that the market was going to end up being down today. And so one of the things that confirms that fear is, and let's go and take a look at what's happened. Okay, so we're seeing this normal pattern, right, from upper left to lower right of all of the futures, and we can see this over time, and we can see that up until right here, 3 o'clock on a few Wednesdays ago, everything looked like it was getting back to normal. We ran up into the close. It's probably just noise. I attribute it to this stuff, right? We had that big sell-off, and then it was also as we ended up going through expiration, and so there were a lot of rolls, and so these 3 or 4 days, from the Wednesday through the end of the week to the Monday, until the Friday at the close, there was a lot of noise because there was fear what happened. Monday, everything was, there was bliss in the world, and everything started to be normal again. However, going into the end of the previous week, there was a little bit of, it's not a big deal, right? It's not a big deal when they end up, there's always going to be noise like this. There's always going to be bouncing around. But Monday was a big deal, right? Monday was a big deal, and you can see what ended up happening here is that the short term, and let's get this back to VIX because I want to end up having just the lines. It's easier to see. Okay. And so what ended up happening is that the short term in the blue line actually, at this point, we went into backwardation. Backwardation is when the front month, bright blue, gets to be above the second month. Okay. And you can end up seeing that right here, right, on Monday. So for a couple of hours, maybe an hour, hour and a half on Monday, it was the first time we were in backwardation in a long, long time. Okay. Then we started to end up selling off over the next couple of days. It had appeared by Wednesday we were getting to be rather normal, but don't forget, this was the point at 2 o'clock that I told you about. We were also meeting resistance. When we met resistance and then we started to see the selling pressure, look at what ended up happening. The VIX ended up shooting up. The VIX shot up. The front month VIX future shot up much more than the second month. And look at what happened on Friday, right? We had a little bit of selling pressure on Friday. The VIX futures the front month, are higher than the second month. This morning, right, we opened up. Everything should have been fine, right? The market's moving up. We were gaining from the time we were talking.
At about
When
7
we
o'clock.
began, we were probably about +7. We got up to, I think, probably +11 or so. But if you take a look at this, what ended up happening is that the VIX futures front month is kept going up higher. This is a concern. This is a major concern. Okay, and so this is something that really, really ends up scaring me. One of the things I'll end up doing is I'll go from a 15-minute chart to down to a 5-minute chart because, like I said, I'm concerned here. And so now when I take a look at, oops, that was too much. Let's go from this point. Okay. So you can end up seeing here that things look like when we were going up might have been okay. Now see, I can see a little bit more detail here in the blue one. We're trying to get back to normal, but as soon as we didn't by 9:55. Now here, let me show you why. Okay, let me show you why this is so important. Let's take this chart right here. Let me move this up to here. Oh, you know what? I can do it this way. I forgot. Okay, and let me put the E-minis over here. Let's do the same thing. Let's get a 5-minute chart, right? 20 days, so that we're looking at apples to apples. Okay, and no. Oh, I got to get rid of the. I did that over here, so I need to do it over here too. Let me come over to here. Let's go to futures. Let's not look at extended hours. Okay, and now what we're going from last Wednesday. Up higher. It's not perfect, but what I want you to end up seeing is the following. You know what? Let's just do, I know what we'll do. Let's look at just today. I'm going to come over to here, 1 minute today. I'm going to take a look at 1 minute today here also. So and I got to. Okay, they're relatively lined up right now, almost. Okay, we're going up. Okay, I want you to see this, right? We're going up. Okay, the VIX is coming down. That's normal. We slide sideways. We move to a little bit higher. VIX is still a little bit lower. But here's what I want you to see. I want you to see that during this part right here, why is the VIX futures front month moving up more than the VIX second month? You see, clearly at this point, there's starting to be separation. If I end up coming over to here, let me do this to make it a little bit easier to see. Let me go over to studies, edit studies, and let's get rid of everything later down here. That's the first 4 months. We don't need N. I just want to take a look at the first 3 months. It's one of the things I hate about Thinkorswim. Right? What happens is it changed everything back to percentages. So what you have to end up doing is coming back to over here, take a look at time, price, and uncheck percentages. If anybody knows how to end up doing that from a default, please let me know, because that's a pain in the butt. Okay. So here's what we can end up seeing. Look at this. Look at how the VIX futures, in the front month started to move higher than the second month. And it started over here. Look at what happened. We kept going up. But this kind of foretold, hey, you should be concerned here because the VIX futures are moving higher, but yet the E-minis were going higher also until we got to a high. And look at what's happened since we've hit our high. right? We've had a 6 point pullback in the E minis, and now instead of being plus 12 like we were at our high, we're only at plus 6. Okay, so many times. Okay, the VIX futures will end up foretelling the direction of the market in a short term basis. It also foretells the market in a longer term basis. Not that we've just hit just the first few months in here, first 2 months, but also when you take a look at a larger picture. Okay, that becomes really important, and it is one of the key things that I will end up looking at all the time. Okay, and it's the reason why on my trade tab, right, my active trade tab, and let me bring that one over because I think I shut it down. Okay, on my active trade tab, that's why I not only keep the VIX futures, the front month VIX futures, VX, in my bar chart, but I also end up keeping, and I detached it, so I have to do the exact same thing again. Right, take a look over here, get rid of percentages. Okay, why we see the exact same thing here with the VIX futures front month moving more than the second month. Okay, becomes very, very important. Let me go to some questions. Oh yeah, Pedro ended up actually texting me and saw this happening right in here. And see, I went through a lot of trouble to show you something that I have automatically on my screen. I saw the VIX or the E minis continuing to move higher, but separation getting greater and the VIX going higher. That's something that you should always worry about. Um, and so that didn't. This is the way that I synchronize it on a 1 minute chart. Okay, I look at 1 minute here. I ended up basically, and you can see this if I come to style. I do 1 minute, 1 day. Okay, and I leave this. I don't leave this up all the time, but this is the way I end up keeping my active trader screen so that they're synchronized. Okay, 1 minute on each side. I do look at them. You don't have nearly the same volume on the VIX futures, so a lot of times you have to get rid of the overnight. But what I do is that once I get the line set up, now they're done for the day. Okay, and I'll look at it. I go through maybe every hour. I go through a cycle where I take a look at things. Okay. Can I share my VIX related charts? Okay, buying and clicking the buttons. Okay, chat window. I'm not sure how to end up doing that. I've shown you how to end up doing this. And so we'll end up working on it. I know that there's ways where I can end up actually giving you my charts and you guys can end up following them. What I did, and let me just minimize this, what I ended up doing here, and let me go back to my screen. This is a pain in the butt to end up keeping, all right? Because every single month I have to end up updating this, okay? And the way I have to update this, let me just show you the studies, is that I have to end up keeping each and every comparison line up to date, okay? So I need to end up knowing, okay, what each letter is, right? And I've shown you guys this before. I think I have. Let me go over here. I never remember where it is. It's a greatest professor I ever had. I used to end up quoting Albert Einstein saying, "Never memorize anything you can end up looking up." Right. So VIX futures contract. Let's go to specs. VIX futures contract specs. No, it wasn't that one. I don't know. Do you guys remember where the date is? I always forget where the date is. I found it and I printed it in it. No, these are downloads, aren't they? Oh, there it is. Okay, got it. Okay. I'll end up leaving this up here. I'll also end up putting this in the chat. Okay. I just posted that in the chat. And so here's what I want. I just didn't go down before. There are your months and your letters, right? You should definitely end up knowing that. You see this little chart here? I actually have that printed on a piece of paper, taped to the side of my screen because I always forget which letters, which month, okay? Having said that, I'm closing this. Here are my letters. Okay, I end up going in. You can see the first one is J. J is April, right? J7 is April 2017. K7 is May 2017. M7 is M is June 17. So if I end up clicking on the first month, right, the bright blue is the short term, right, and then the K is the aqua, right. The next color is going to end up being green for M, right? M being June, and the last one I'll just show you is July, which is N, and that's going to be yellow. So what happens is that I've made the colors in such a way so that it's easier for me to end up seeing. And this way I can end up tracking that, okay? You can go to certain websites and find things, okay, instantaneous. Big Central is a good place, but it doesn't tell you where you've been, and if you haven't been watching things all along, things could end up happening and you miss them. Here, by keeping a 5-minute 20-day or a 15-minute 20-day. It lets me look back and I can see if there are any spikes or anything. Then if I need to end up going to something less, I do. Okay? That is it, guys. Any last questions? I think that for anybody who is an options trader or directional trader, the stuff that we went over today is, I think, mandatory for your financial survival if you're going to end up trading. It is probably the most important stuff that I do on a regular basis. Okay, how you end up using that in your trading is up to you. This is the way I end up using it a lot of times in mine when I decide when I'm going to adjust, how am I going to end up adjusting. I try to end up always keeping my risk management in the front of my mind. I don't do anything, okay, using this for my trading if the risk rewards don't end up also lining up in my favor. Right now, the risk rewards don't line up in my favor for me to end up taking action that the market may end up selling off. I'm already in negative delta enough, but it does end up meaning that if I was thinking that I had to end up adjusting, I'm going to wait a little bit longer. Okay, I'm going to let this play out if I needed to end up buying anything, which at some point I might. Right now I don't, though. Okay, guys, thank you very much. I'll talk to you soon.